Here's the shocking truth no one will tell you about the markets. Most traders think the market is unpredictable, chaotic, and impossible to master. They study charts, memorize patterns, follow indicators, and yet month after month, they watch their accounts bleed. Why? Because they've been looking at the market the wrong way. The truth is, the market is not random. It obeys structures, hidden patterns that repeat over time across assets and across timeframes. And understanding these structures is the difference between reactive guessing and intentional mastery. Welcome to Trading Rebels, the channel where we expose the old myths, break the chains of reactive trading, and teach you to see the market the way it really is. If you're tired of losing to randomness and ready to build consistency that lasts, you're in the right place. The market doesn't reward effort, it rewards alignment. And today, we're going to start seeing why. Structural repetition. The first truth every trader must internalize is that the market is built on repetition, not random repetition, not coincidence, but precise structural repetition that governs how price moves. Most traders think that patterns are tricks or lucky occurrences, but if you start looking closely, you'll realize that the same dynamics play out over and over again. Every trend, every retracement, every breakout is a variation on a recurring theme. The market doesn't invent new rules every day, it recycles behavior. And this repetition is not limited to a single time frame or a single asset. It's a universal rhythm hidden beneath the surface of chaos. Now let's get real. How many times have you looked at a chart and thought, this looks different from anything I've ever seen? You're not imagining it. At first glance, it does. But if you step back, if you strip away the noise, the price action is still following the same structural rules you've seen before. Higher highs, lower lows, consolidation, momentum shifts, reversals, they're all echoes of the same underlying pattern. Structural repetition is not about memorizing a chart, it's about seeing the rhythm beneath the price movement. And here's the part most traders miss. They chase the illusion of uniqueness. Every new candle feels like a new puzzle. Every news event feels like a disruption of reality. But the market doesn't care about your perception. It only cares about probability expressed through structure. Repetition creates predictability. It's why the same setups appear over and over again. It's why a breakout pattern today behaves much like a breakout pattern 6 months ago, even if the asset, time frame, and context are slightly different. The market speaks a language of recurrence, and the moment you recognize that, your entire approach changes. Structural repetition also exposes the failures of conventional trading thinking. Traders are told to react to every new candle, to respect every indicator, to adjust for every spike in volatility. They try to impose discipline on chaos. They think that memorizing more rules will make them profitable. And yet, without seeing the underlying repetition, all the rules become noise. You may be disciplined. You may follow every indicator. You may journal like a monk and still fail. Because rules without recognition of the repeated structural dynamics are powerless. They are a boat without an anchor, drifting with every wave of randomness. This is why the Rebels' approach is so different. We don't react to each candle as a unique challenge. We study the recurring structures, the frameworks that repeat across assets and across timeframes. When a certain price behavior repeats, we recognize it instantly, not because we memorized it, but because we understand the structure that produces it. This is the edge that disciplined rule followers will never achieve. Structural repetition allows you to anticipate movement before it happens. It gives you a lens to see probability in motion, not guesswork. Think about it in practical terms. Imagine observing a single currency pair over the course of a week. You notice a consolidation forming near a historical level. For a typical trader, this may seem random, a coin toss of uncertainty. But a rebel sees it differently. They recognize the structural repetition. Price often consolidates near these levels before continuation or reversal. The patterns of accumulation, distribution, and breakout are the same structures that have occurred countless times before. And because they recognize the repetition, they can act with intention, not reaction. Here's another truth. Structural repetition is forgiving. Unlike discipline, which collapses under emotional stress, repetition is a constant. You don't need to summon willpower to identify a repeated structure. It's present regardless of your mood, your distractions, or market volatility. It doesn't care if you slept poorly, if you're overleveraged, or if you're emotionally charged from the previous loss. The structure repeats. It remains true. And your job as a rebel trader is to align your behavior with it. This alignment is what converts the chaotic noise of the market into a disciplined process without requiring constant mental effort. Recognizing repetition allows you to build trades that are probability-based, not hope-based. When you see a recurring setup forming, your mind doesn't panic. Your actions are guided by the structural reality that has been proven over countless cycles. You are no longer reacting. You are implementing. And this is the secret most traders will never see because they are trapped in the illusion that every trade is unique. Every market moment is unprecedented. It's not. The market is far more predictable than anyone admits. It's just that predictability is coded in repetition, not rules. Let's reflect on a common scenario. You've likely experienced a breakout that fails or a reversal that surprises. Most traders blame the market, their strategy, or their psychology, but a rebel sees something different. They ask, does this price behavior align with a recurring structural pattern I've seen before? And if it does, the probabilities are on their side. If it doesn't, they wait. They avoid unnecessary exposure. The repetition is the filter through which all trades pass. Without it, you are trading blind. Here's the final truth about structural repetition. It creates confidence that isn't emotional, it's architectural. Confidence from discipline is fragile. It crumbles under pressure. Confidence built from structural recognition is resilient because it is grounded in reality, not hope. The moment you internalize that the market obeys repeatable structures, fear and greed stop controlling your decisions. You are no longer trying to force outcomes. You are aligning with the recurring design the market already follows. Reflect on this with me. The charts you've stared at for hours are not unique landscapes of chaos. They are mirrors of the same structural patterns you've seen before, written in slightly different languages, across different assets, across timeframes. Every accumulation zone, every breakout, every retracement is a repeat performance, and the market rewards the rebel who can recognize it. Those who ignore it, who chase randomness with discipline alone, will continue to lose. Structural repetition is not a trick. It is not a shortcut. It is the truth behind every winning trade you've ever dreamed of. It is the lens that transforms uncertainty into probability, chaos into clarity, reaction into intentional action. And once you see it, everything changes. Every candle, every chart, every setup becomes a teacher. Every movement becomes a message. And you, the rebel trader, start to operate not in hope, but in alignment with the market's enduring rhythms. Frameworks across assets. Once you begin seeing structural repetition, the next revelation hits you like a thunderclap. These structures don't belong to a single market or asset. They are universal. The patterns you spot on a Forex chart, the retracements on a cryptocurrency, the consolidations on a stock index, they all follow the same frameworks. This is not coincidence. The market is a living system, and the forces driving price movement are fundamentally consistent, whether you're looking at a major currency pair or a small cap equity. Recognizing that framework is what separates traders who stumble from those who dominate. Most traders, even when they notice structural repetition, they remain trapped in their silo. They think, this works on E or USD, but Bitcoin behaves differently. Gold is another beast entirely. And because of this siloed thinking, they fail to generalize, to scale, to truly harness the universal principles that govern price behavior. The market isn't fragmented, it's modular. It's the same engine operating in different shells, and every asset is just another expression of that engine. Here's the moment most traders miss. Understanding frameworks across assets isn't just about spotting similar patterns. It's about recognizing the underlying rules that generate those patterns. What drives repetition in a currency pair also drives repetition in a commodity. Supply and demand, liquidity flow, human psychology, institutional behavior, these are the constants. The assets change, the volatility shifts, the time frame adjusts, but the core dynamics remain the same. And once you internalize this, the market becomes scalable. Your edge is no longer limited to one chart or one instrument. It can be applied anywhere. And here's a rebel reality you need to embrace. The moment you understand frameworks across assets, your trading transforms. You stop thinking in isolation. You stop chasing a single setup on one market and hoping it will work. Instead, you build a system, a universal framework that identifies these recurring structures wherever they appear. You start to see the market like a chessboard, not a scatter plot. The same rules that gave you an edge in one asset give you an edge across the board. By now, you're probably realizing the potential. But let me pause here and make this interactive. If you're watching this, comment below with the asset you've struggled with the most. Was it stocks, crypto, Forex, or commodities? And ask yourself honestly, have you ever tried to apply the framework you learned in one asset to another? Chances are you haven't. That's exactly where most traders leave money on the table. Now, hit that subscribe button if you're ready to break that cycle. Share this video with a trader who is stuck in one market, and comment below. Let's expose the myth that different assets require entirely new strategies. Back to the point, understanding frameworks across assets is about seeing the invisible architecture behind price. It's about recognizing that each market is not a separate puzzle, but a mirror reflecting the same universal forces. And when you see that, you realize that every setup you take, every pattern you recognize, every trade you enter has applicability beyond what you initially thought. You're no longer a trader limited by the asset you trade. You're a rebel with a system that scales. Think about a simple scenario. You've mastered breakouts on E or USD, and you notice that a breakout on Bitcoin is forming the same accumulation pattern. A typical trader might hesitate, thinking, crypto is volatile, it's different, I can't risk it. But a rebel sees the framework beneath the asset. The structure is the same. The probability is the same. The trade logic doesn't change. You've just multiplied your opportunities because you're operating through frameworks, not fear. This realization has cascading effects. Not only does it expand the markets you can trade, but it also sharpens your analytical skills. By studying frameworks across assets, you begin to identify the universal behaviors that underlie price movement. You stop relying on luck, intuition, or anecdotal patterns. Instead, your actions are guided by principles that transcend specific markets. And that's where consistent profitability is born, when you trade in alignment with universal structures, not asset-specific illusions. Let's get real for a moment. How many times have you watched a breakout succeed in one market while you were paralyzed, convinced that it wouldn't translate elsewhere? That hesitation isn't caution. It's ignorance of framework. It's failing to see the universality that exists beneath the surface. The truth is, markets are mirrors of each other, and the frameworks that govern one can guide your trades in another. Recognizing this is not optional. It's fundamental. When you integrate frameworks across assets into your system, you also unlock efficiency. You don't need to relearn setups for every new asset. You don't need to chase exotic instruments hoping for a unique edge. Instead, you can apply your system universally, testing probability in multiple markets simultaneously. That's the rebel approach, scalable structure that frees you from the tyranny of asset-specific thinking. Reflect on this. Every time you resist the urge to silo your knowledge, every time you apply a proven framework to a new market, you are building versatility. You are building a system that adapts, that multiplies opportunity, that maximizes probability. You are no longer reactive. You are structural. And when you trade like this, you stop chasing randomness and start riding the currents of repeatable probability. Here's the final insight. Frameworks across assets are the bridge between repetition and scalability. Repetition shows you the patterns. Frameworks show you how those patterns apply universally. Together, they allow you to operate at a level most traders never reach. They allow you to see the market not as an endless maze of chaos, but as a modular system where every asset is another room, every structure is another door, and every trade is a step forward, guided by the architecture you've learned to recognize. If you've grasped this, you're beginning to see why most traders fail. They limit themselves. They see markets as isolated islands. They ignore the frameworks that connect everything. And in doing so, they leave opportunity and money on the table. Rebels see the connections, act with intention, and scale their advantage across the entire market landscape. Scalability of structure. By now, if you've been following closely, you're beginning to notice a pattern. The market isn't chaotic, it's structured. Repetition exists. Frameworks exist across assets. But there's a deeper truth most traders never reach: the scalability of structure. Repetition and frameworks are powerful, but without scalability, they remain static. They are insights, not leverage. Scalability is what transforms your understanding from a theoretical edge into actionable, compounding profitability. Here's the reality most traders miss. They can identify a setup, see a repeated structure, maybe even apply it across 2 or 3 assets, and feel confident. But when the opportunity appears across multiple markets, multiple timeframes, or with increasing capital, they freeze. Why? Because they don't understand that structure can and must scale. Structure is not limited by chart size, asset, or account. It is a principle. It's the blueprint the market follows, and when applied intelligently, it can carry your trading from a single trade to a consistent system that thrives across complexity. Think of it like music. 1 note played beautifully is pleasing. 2 notes in harmony is more impressive. A full orchestral arrangement, applied correctly, is breathtaking. Scalability of structure is the orchestration of your trading knowledge across every opportunity the market presents. It allows a single insight to multiply across trades, timeframes, and instruments, creating exponential advantage. Most traders never get here because they are still trapped in the mindset of 1 trade at a time discipline. They haven't realized that probability compounds when structure scales. Here's the practical truth. Scalability doesn't mean you trade everything at once. It means that the system you build for 1 scenario works in other scenarios without requiring you to reinvent it every time. It's about creating a model that isn't fragile, that doesn't break when you increase position size or shift markets, that doesn't crumble under market complexity. This is why most traders who rely solely on discipline fail. They have no scalable architecture. They rely on mental effort alone, which is finite, inconsistent, and vulnerable to emotional overload. By the way, if this video is adding value for you, take a moment to like it. Your support helps us reach more rebels who are tired of losing to randomness and ready to trade with structure. And if you're watching this and thinking about sharing it with a friend, do it. This knowledge multiplies in impact when shared, because scalability in learning is as important as scalability in trading. Back to the point. Scalability of structure also allows you to adapt your edge to different market conditions without losing its core integrity. Imagine a framework you've mastered for trending markets. Most traders think it's useless when the market consolidates or becomes volatile. Not rebels. Scalability means your system retains its validity across varying conditions. The structure flexes, adapts, and continues to generate probability, even when the market's surface behavior changes. You aren't dependent on a single scenario. You're aligned with the architecture that underlies all scenarios. And let's get even more real. How many traders have you seen succeed on a small account only to falter when they increase risk? It's the same mistake over and over. Scalability isn't just about applying structure across markets. It's about applying structure across scale. Position size, account growth, leverage, multiple trades at once. The underlying principle stays the same. The probabilities remain intact, and your model continues to function because it was designed to scale from the start. This is what separates rebels from the crowd. They don't grow by hope. They grow by structure. Here's another way to think about it. Imagine building a house. 1 room is functional. 2 rooms are better. 10 rooms, a multi-story home, a mansion. It all works because the underlying blueprint is sound. If your foundation cracks or your design is inconsistent, the entire structure fails when scaled. Traders without scalable structure experience the same failure. Their insights, setups, and strategies are fragile. They work only in controlled, limited scenarios. The moment complexity increases, they collapse. Rebels design with scale in mind. Every principle, every pattern, every trade logic can expand without losing integrity. And here's a subtle but critical insight. Scalability of structure reduces emotional load. When you know your system is scalable, you don't panic when opportunity multiplies or markets fluctuate. You don't overthink or second-guess yourself. Your model handles complexity automatically. Your execution remains calm and intentional because the framework has been stress tested across scale. Discipline becomes secondary. Your structure carries the weight. That is the ultimate leverage. The mental clarity that comes from knowing your system is not fragile, but expansive. Let's pause and make this reflective. How often do you limit yourself to small trades, small assets, or single markets because you doubt your capacity? That hesitation is cost. It's lost probability. The market is infinite, but your mindset constrains you. Scalability of structure is the antidote. It trains your mind to see beyond constraints, to recognize that the principles you've learned can be applied universally, and that your edge is not bound by size, scope, or circumstance. If you've been trading reactively, this may feel counterintuitive. You've been taught to control every move, to micromanage every position. Scalability flips that mindset. It says, build a system once, align with structure, and watch your probabilities compound. You're not adding more discipline or effort, you're multiplying your impact by letting the market's inherent structure do the work. This is what turns traders into rebels. Finally, consider this. Scalability is not theoretical, it's practical. It's visible in every multi-asset portfolio that succeeds consistently. It's observable in how professionals replicate setups across timeframes. And it's experienced personally when you increase your exposure, apply a framework to a new market, or navigate complexity without fear. The market doesn't reward effort, it rewards design. And the more scalable your design, the more reliable your outcomes. Market universality. By now, you've seen structural repetition, frameworks across assets, and even the scalability of those structures. But there's a deeper truth lurking beneath the surface. A truth that most traders ignore because it challenges everything they think they know. The market is universal, not just in repetition, not just in framework, not just in scale, but in principle. Whether you are trading Forex, commodities, equities, crypto, or indices, the same forces govern price behavior. Human psychology, liquidity flows, institutional activity, and market mechanics, they operate the same way across every arena. And once you understand this universality, you see opportunity where others see randomness. Most traders fail here. They treat every market as a separate entity, as though each one requires a unique strategy or a different mindset. Stocks are slow, crypto is volatile, Forex is tricky. They compartmentalize, silo their thinking, and miss the patterns that transcend individual instruments. But the truth is, the market speaks one language, and it uses the same grammar everywhere. Structural repetition, framework consistency, and scalability are not exceptions. They are universal laws. The sooner you internalize this, the sooner you stop being a reactive gambler and start being an intentional rebel. Here's the reality. Universality doesn't mean the assets look identical or behave in the same way minute by minute. It means that the underlying principles, the forces that drive price, remain consistent. Support and resistance, accumulation and distribution, momentum shifts, liquidity imbalances, they are present in every market, expressed in slightly different accents, but the core logic never changes. And this is where most traders falter. They chase superficial differences while ignoring the fundamental patterns that repeat across all markets. Think about a trader who only trades URUSD. They become comfortable. They develop confidence in their setups. But one day, they look at crude oil and see a similar structure forming. Do they recognize it? Often, they do not. They hesitate, overthink, or dismiss it because it's different. That hesitation is cost. The rebel sees the same structural principles regardless of the market and acts intentionally. Universality allows probability to follow you wherever you go. It frees your strategy from the confines of a single market, turning every liquid instrument into a potential opportunity. Let's pause and make this reflective. Look at the last trade you took on an asset you didn't normally trade. How much hesitation did you feel? Were you analyzing a new chart as if it were a puzzle with unknown rules? Or were you applying the same frameworks you've seen elsewhere? Universality is the bridge that allows you to act confidently across unfamiliar markets. Without it, every trade outside your comfort zone becomes a guessing game, driven by fear, uncertainty, and hope. With it, every trade becomes intentional, calculated, and repeatable. And here's the subtle beauty of universality. It reinforces your learning exponentially. Every time you recognize a pattern in one market and see it validated in another, you deepen your understanding of the market's fundamental structure. You are no longer limited to anecdotes or single asset observations. Your probability advantage compounds because your edge is not bound by a single context. The more markets you observe through the lens of universality, the stronger your alignment with the market becomes. You are building a mental map that spans multiple instruments, multiple timeframes, multiple scenarios, and all of it operates according to the same principles. Here's a rebel truth that's often overlooked. Universality makes your edge portable. Once you internalize it, you are no longer tied to the instruments you trade today. You can adapt to emerging markets, new asset classes, or sudden shifts in liquidity without having to start from scratch. The structure carries across contexts. Your process becomes resilient, adaptable, and independent of the superficial details of any single market. This is why rebels never panic when faced with unfamiliar conditions. They see the same game being played, just with a different set of pieces. Reflect on probability in this context. Most traders think probability is asset-specific. They calculate risk and expect outcomes in isolation. But universality shows that probability is consistent across contexts, as long as the structural principles align. A setup that works repeatedly in one market has a high probability of repeating elsewhere because the forces driving it are the same. Traders who fail to recognize universality are blind to opportunity. Rebels, on the other hand, move confidently because probability is not a guess. It is a reflection of structural truth expressed universally. Let me make this interactive for you. Take a moment and look at 3 different markets you're familiar with. Spot a common pattern, a recurring behavior, a structural rhythm. Don't think superficially. Dig for the principle behind it. That's universality in action. Once you see it, you'll realize that what appeared to be isolated events were actually different expressions of the same market laws. This realization is not just intellectual, it changes your execution. You trade with intention because the market has already proven itself across multiple contexts. Finally, let's reflect on why universality matters more than you think. Traders get caught in complexity, believing that more markets, more indicators, and more variables increase their edge. In reality, the opposite is true. Complexity without recognition of universality is chaos. It's decision paralysis. Rebels reduce complexity by seeing the constants beneath the noise. Universality allows you to trade across multiple instruments without overcomplicating your process. It aligns your probability, scales your opportunity, and ensures your edge is consistent, repeatable, and resilient. The market may appear infinite, but universality reminds you that it is not unknowable. The rules don't change. The structures don't disappear. The probability doesn't vanish. And if you align yourself with these universal principles, the market no longer intimidates you. It becomes predictable, navigable, and remarkably consistent. And that, ultimately, is the advantage that separates rebels from reactive traders. Understanding that the market is one system expressed in countless forms, and aligning your strategy with that truth every single time. Probability in practice. By now, you've explored structural repetition, frameworks across assets, scalability, and universality. You've seen how patterns repeat, how frameworks translate across markets, how structures scale, and how universal principles govern every asset. But all of this is incomplete without understanding probability in practice, the final piece that converts insight into execution, analysis into profit, and observation into mastery. Probability is the lens through which every rebel evaluates the market. Most traders think probability is abstract or theoretical. They believe following rules, patterns, or indicators is sufficient. But probability is not about memorization. It's about alignment. Probability measures how likely the market is to behave according to the structures you've observed. And when you apply it practically, it allows you to act with confidence, even when uncertainty is unavoidable. Let's be real. Every trade is a gamble if you don't account for probability. Even with perfect discipline, a trader who ignores structure is at the mercy of chance. They may win sometimes, but losses are inevitable, and stress compounds. Rebels, however, understand that probability is not luck. It's a reflection of recurring structures expressed across multiple assets, scales, and market conditions. When you trade in alignment with these probabilities, your edge becomes tangible, repeatable, and measurable. Here's an interactive reflection for you. Think of the last trade you entered that felt uncertain. Were you relying on hope, emotion, or discipline alone? Or did you have a framework, a scalable structure, and universal principles to guide your decision? This distinction is what separates traders who stumble from rebels who thrive. Probability in practice isn't theoretical. It's experienced every time you execute a trade that aligns with proven structure rather than reacting to randomness. Now let's bring this to life. Imagine a recurring pattern you've identified, a breakout after consolidation, for example. You see it repeat across multiple assets. You know the structure, you understand the framework, you trust the scalability, and you recognize its universality. At this moment, you're not guessing. You're acting on probability. You don't rely on discipline to overcome fear, because the edge is baked into the structure itself. Execution becomes almost automatic, and the market rewards alignment consistently over time. Probability in practice also teaches restraint. Rebels don't trade every opportunity, and they don't chase setups that don't align with their understanding of the market's architecture. Probability is selective. It filters trades. It dictates when to act and when to wait. This is why so many traders fail. They attempt every trade, rely on discipline to survive losses, and exhaust themselves in pursuit of outcomes they have no real edge in. Probability doesn't require heroism. It requires patience, alignment, and application. Here's a reflection to internalize. Every time you enter a trade without a probability-based framework, you are gambling. Every time you execute without confirming alignment with structure, universality, and scalability, you're leaving yourself vulnerable. Rebels do not gamble. They calculate. They measure probability across every dimension they've learned: repetition, frameworks, scale, universality. And when those align, the probability favors them consistently. Let's make this interactive. Take a setup you've been considering. Ask yourself, does it repeat structurally? Can the framework be applied across other assets? Does the structure scale with my position size and account? Does it reflect universal market principles? If the answer is yes, probability is in your favor. If not, you step aside. This is how probability is practiced in the real world, not in theory, not in wishful thinking, but in disciplined application of structural truth. And here's the rebel advantage. Probability reduces emotional friction. Traders who ignore probability fight themselves on every trade. They second guess, they hedge, they override their rules. Rebels, however, see probability as a guide. It doesn't remove uncertainty. It clarifies action. It doesn't eliminate losses. It aligns them with expectation. Losses are no longer disasters. They are the predictable outcome of probabilistic reality. Gains are no longer lucky. They are the logical result of alignment with structure. As we reflect on this, understand that probability is not a trick, a shortcut, or a magic formula. It is the natural consequence of observing the market honestly, understanding its repeated structures, translating frameworks across assets, scaling them intelligently, and recognizing the universality that governs price. Probability is the final arbiter, the proof of alignment, the metric that validates your rebel approach. And now, let's bring it all together. You are a rebel trader because you do not rely on hope, discipline, or luck. You act intentionally. You see repetition. You apply frameworks across assets. You scale your structures. You recognize universality. And you trade in alignment with probability. This is not a strategy that fails under pressure. This is not a system that collapses with volatility. This is a blueprint for consistent, repeatable, high-probability trading across time, assets, and conditions. Here's your call to action. If this resonates, hit that subscribe button and become part of the Rebel community. Like this video to let the channel know we are building traders who refuse to gamble with randomness. Share it with every trader you know who struggles with consistency. Comment below your reflections. What structures have you recognized, and where have you applied probability in your trading? Your participation strengthens the community and amplifies the learning for every rebel watching. Finally, take a moment and internalize this. The market will always move. Price will always fluctuate. Volatility will always exist. But if you build your trading around structural repetition, frameworks, scalability, universality, and probability, You don't need to fear the market. You don't need to guess, hope, or rely on discipline alone. You have a system. You have alignment. You have an edge. And that, above all, is what makes a rebel trader unstoppable. Go forth, trade with intention, align with structure, and let probability be your guide. The market has its laws. Now, so do you.